Good afternoon. Thank you for joining us. My name is Dick Shapiro, and I'll be moderating today's webinar called A 2020 Vision for the Compensation Committee. I'm on the boards of both Molina Healthcare and Transamerica, and I chair the Compensation Committee at both companies. It's hard to believe, but we are already closing 2 decades of the new millennium. This is the time of year when many look back and reflect, but as directors, there's just too much going on right now for us to enjoy that luxury. It's time for boards to look ahead and prepare for the significant changes coming in corporate governance. This is particularly true for the Compensation Committee, whose role seems to be expanding, while the focus on executive and director pay is also increasing. Today I'm joined by Peter Lupo, the head of Pearl Meyer's Atlantic region, and his colleague Scott Evanson, a vice president in the firm's Boston office. Our conversation is going to center on Pearl Meyer's their annual top 5 identified trends for the coming year, a potential roadmap for getting ahead of some of the compensation topics that are very much top of mind and gaining steam. I think that the Pearl Meyer team has done a terrific job of coming up with this list, and if you happen to be scanning ahead to page 5 of the slides, essentially they are the role of EVA and comp plans, the growing acceptance of ESG and how to disclose and include the related metrics. Number 3, on how directors on comp committees should be responding to the expanding charters and responsibilities that seem to be getting downstream to the comp committee. When we should use, quote, adjusted metrics. And finally, the pros and cons of expanded disclosure around comp plans in your proxies. Before we get started, I'd like to turn the webcast over to Sienna Breen with the NACD's education team. She'll take us through a few short housekeeping notes before we get into the meat of the presentation. Sienna?
Great, thank you, Dick. Audience, I have a few housekeeping announcements to share with you today before we get started. On the right-hand side of your webinar console, you should see several boxes. At the top, you can submit a question to be answered by our speakers during the program, time permitting. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. And also on the right-hand side of your console, you can tweet live with us using @NACD and @Pearl Meyer. And in the bottom right corner, you can download a copy of today's slide deck, register for our next webinar, and access additional resources. You will automatically receive 1 NACD skill credit for participating in this webinar. Credit may be applied to NACD fellowship programs, and you can contact fellowship@nacdonline.org for more details. And this is for the live program only. A recording of this webinar will be available early next week at nacdonline.org and pearlmeyer.com. And finally, we will have a few anonymous evaluation questions at the end of the program, and we would really appreciate your feedback, so please stick around at the end of the webcast to answer those questions. And now I'd like to turn it over to Scott to get us started.
Okay, hello everyone. So I'm going to be handling the first section of this, which deals with EVA and ISS. So EVA, a popular metric in the 80s and 90s, has become less popular since, but ISS is trying to bring this metric back into the compensation discussions. I think on page 6, actually, the second bullet is actually a little more important than the first, and just in regard to the CEO pay for performance tests, although EVA is now going to be included for the 2020 year, it's still a secondary metric, so your companies will still be, the compensation will still be tested against TSR as the main point for ISS pay for performance recommendations. But as a secondary metric, if it trips up on that, EVA will come into play. So, you know, this introduction of EVA basically brings up some questions that you might have from a company perspective, just specifically, how is ISS using EVA? You know, how's our company going to fare in the EVA metrics? And then also, should the company have EVA in our comp programs if it's already not there? What I would say in terms of like ISS using EVA, they are going to make, it's not going to be an EVA, they're going to make standardized adjustments to the EVA, and it's not EVA in particular, it's actually going to be EVA ratios. So the idea is that they would want to basically try to standardize the process to be able to compare relatively across that. The second thing I would point out is that ISS has a black box model, which will be very tough to reproduce. So, you know, I guess I would say, you know, in terms of introducing EVA, if it's not relevant to your company, you probably shouldn't just do it just for the ISS pay for performance test, because A, it'd be very hard to back into their numbers, and B, on a relative basis, you would have to basically figure out what companies were in the peer group versus, you know, in addition to basically trying to model yours to have any meaningful results in regard to the ISS. I would say also that you can get at certain elements of EVA, or what that tries to come out with in terms of profit growth and capital efficiency through other metrics, which basically are more straightforward to a model and be explained to both you know, the comp committee and your employees as well. So I guess that's that for that page. Dick, do you have any kind of thoughts on EVA in general, or just ISS as you use that?
Sure. Thanks. I guess I would start by saying I'm not a fan of EVA, and I'll take it from the point of view of both the employee and from the board. From the employee's perspective, if the purpose of a comp plan is to incentivize and motivate a management team, I find it somewhat antithetical to think that a highly complex black box formula is going to be capable of doing that. One of the reasons why CSR is not an effective tool is because management can be doing everything possible, but they can't really influence the stock price, and so to some extent it defeats the purpose of motivating your personnel. And I think that this is taking it one step further. It's just making it even more complicated to understand. So that's from the employee's perspective. From the board's perspective, I would say I would also be concerned that because this is including the cost of capital, it may disincent longer-term strategic investments that require capital and patience. Because if it's out beyond the horizon that this is measuring, then it would be viewed as a decision you shouldn't be making, yet it's not the right thing for the company in the long term. So the cynic in me says that this is ISS really trying to commercialize the company that invented this notion of EVA. But I just don't think that it is really the right kind of tool to provide the incentives that you need or want. So I'm not a big fan.
Okay, that's gonna be the end of the EVA discussion. I'm gonna pass it along to Pete for the ESG portion.
Thanks, Scott. Yep, this ESG is really interesting, and I'll tell you why. ESG has been around for a long time. There are many companies out there that have identified ESG goals. They manage to them. They communicate internally. There's nothing new about ESG. What is new, though, is the attention ESG is getting around incentives. And I'll give you a little anecdote. This past week, I was at a board meeting, and the CFO walked over before the meeting and said, "Hey, Pete, I was just on a call with the institutional investors, and you can't believe how many questions they're asking about ESG, how we think about it, what the goals are, do we plan on more communications around it?" He was actually very surprised and asked me if I had similar experiences. And I told him that although we don't deal directly with the institutional investors, I'm getting the same kind of feedback from many clients about the interest in ESG. And what's very interesting about this is this has all been happening, at least in my world, the compensation space, the interest in the past year or so, to the point where compensation committees are asking, if ESG is so important, do ESG measures and goals, do they belong in our annual incentive plan covering NEOs? And I think that's the topic that committees are raising. That is the topic that Pearl Meyer is raising. Have we gotten to the point where ESG is so important that we have to measure it at the top of the house? And here's a point of view on that. With the exception of companies that clearly have very visible social issues they need to work around, with the exception of those companies, I would say it's a little bit early in the game for a company to identify an ESG metric or metrics and include them in the annual incentive plan. Here's a framework of how I think about this. For most companies, for the annual incentive plan, either the entire plan is based on financial results or some portion. I'm going to call it, let's say, 20, probably at most, in most cases, 40% is based on either individual or strategic goals or something along those lines that are not directly financial goals. if we have those kind of structures in place right now, and we determine that ESG needs to be in that program, do we dilute the effectiveness of the other goals? The annual incentive plan has a big problem. How many goals are too much, and do they get dilutive? And I think that's the biggest challenge for boards right now, to think about ESG in that way. So I would say for now, keep on top of ESG, and unless you have a significant external issue, I think the ESG goals should be managed as you have been managing currently in place. You may want to do expanded disclosure on those goals because investors are asking, but leave it at that. Now, Dick, you may have a different perspective. You sit on boards. So when you start talking about ESG and investor questions, how do you think about the right response?
Well, I agree with what you're saying. Look, unless you're a manufacturing or a natural resource company, it's very hard to come up with measurable metrics that you could include for ESG. But that doesn't mean that you shouldn't include it. In our short-term incentive plan, 70% of it is financially based, 30% of it is discretionary, and it's tied to sort of our broader goals and objectives that are used for evaluating the performance of our CEO and his top reports. So within the discretionary metrics are some ESG elements. And I have to say that since digging into ESG a little bit more, what I found is that clearly shareholders are very concerned about it, employees are concerned about it, your customers are concerned about it. And whether or not you may think that it's a big deal, the fact is that the market and everyone around you that is involved with your company thinks it's a big deal. So it's something that you need to pay attention to. And what we found at one of my companies is as we looked at what we do, we actually are very engaged in this, but we never really talked about it much. And so as a result, and particularly looking at proxies for companies that are very good at this sort of disclosure, what we're starting to do now is get a little more aggressive in actually just laying out the steps that we've already taken but never thought were that big a deal. But when people are looking for it, and ISS is looking for it, institutional investors are looking for it, just put it out there. You'd be surprised how much of it you might already be engaged with.
Yeah, Dick, I think those are some pretty important observations you're making, and I'm thinking about your plan design, which I think is fairly typical. And I'm saying a couple of comments here based on what you've said is, when asked whether or not ESG should be a goal, I think we should remind ourselves that if you have a plan where you have some discretionary component, whether it be a full discretion or maybe some goals where the committee is expected to apply discretion, you have an opportunity to use an ESG outcome as a modifier to a goal or actually performance, and that can send a message if the committee feels like there's a particularly important ESG goal and the management team has done a very good job managing to it. You can apply that discretion to that annual incentive plan or negative discretion in some cases. So I think that's important. The other comment you made, and I should have put more emphasis on it, is I think there's been an explosion of interest by those stakeholders in ESG. And you are right. I think many companies have a lot more they could say about the ESG management, but just haven't, not because they wanted to disclose less, but it didn't seem to be a need to disclose more. But you're right, the information is there. It really comes down to identifying what you want to disclose and how you want to disclose it and to whom you want to disclose it. Because, as you said, the world is asking about it. If we go to a related topic on ESG, one of the comments I have here is that if you're sitting on the comp committee or maybe even the full board, and either you feel like you don't have enough information around ESG or you don't have any at all, and you're asking yourself, well, how do we start getting the management team to be more responsive to the board on a communications basis? We outlined some pretty simple steps here that you could consider asking your management team to explore to get the board more fully up to speed on ESG. So, Dick, this is a 5-step process, pretty simple. I don't think it's intrusive if you ask management to follow up on this, but as you think about those 5 steps, is there a simpler way to do it? Is this overdone? What do you think?
No, I think it's a good way to at least start the process. Again, many companies haven't really given it a lot of thought, so this is a good way to sort of scratch the surface and engage in the process. And it has to be done. It should start at the comp committee, but it also has to be rolled up to the board. So I think you're right in making it a broader effort.
Great. Hey, Scott, before we move on to the next topic, anything you want to add to that? Did we beat it up pretty good?
I think you guys covered everything very, very well.
Okay. Well, thank you. All right, let's move on. Let's go on to this concept of the comp committee's expanding role. And this is a couple of concepts I want to wind into this whole discussion. If you look back 5 years ago, you'd see a lot of comp committees have the title as comp committee. That's their function, to be the oversight for the executive compensation program, clearly. And in the same breath, many companies have titles that may differ. It may say compensation committee and say management development committee, something along those lines to imply a broader reach for the committee. If you look at committees right now, what we see is trending is that the committees are being asked to at least think about much broader issues. And those issues have to do with succession planning and talent development and others as well. But if you're sitting on the committee, you have the responsibility to ensure that your executive compensation program is fully aligned with your near and long-term strategies. That's obvious. What doesn't get asked, I think, enough is whether or not your talent strategies are aligned with your pay program and your business strategies. Do we have the right people? Are they in the right roles? At the right time to support our strategic plan? Those are the questions they want to ask. And when you ask those questions, the role of the comp committee starts expanding. Even though it may not be reflected in the charter, it's expanding because now you're getting into talent management, you're getting into succession planning. And I think what could be a little bit challenging is that what I see on my end, now I'm living in the comp committee, I'm not living in certainly governance of the full board, but what I see on my end in many cases is that the comp committee is pretty focused on compensation, or very focused on compensation, where the leadership and succession planning issues might be handled in governance and or the full board. So here's a thought on that. Maybe it's time for the comp committee's role to officially expand beyond compensation to this whole issue of leadership. And I'm saying that is I think if a committee owns that full responsibility and then reports back to the full board, I think you might get a more effective result in not only managing pay, but managing your people to that to support strategy. So Dick, again, you're sitting in these conversations both at the committee level and you're sitting in these at the board level. Do you agree with that process, or is there another way to tackle this issue?
I think you framed the issue correctly, and I'm not sure there is a right answer, because as long as I've been going to seminars and participating in webinars and whatnot, this question comes up: who is responsible for succession planning? And the answer lies somewhere between NOM and governance and the comp committee. And I think it almost depends who you ask. One of my companies just completed an NACD board evaluation process, and we specifically asked the person that question, and I got a very thoughtful answer. Saying basically for the CEO, it should probably be NOM and governance with very heavy board involvement. For talent identification more broadly through the organization, it's probably the compensation committee. Mm-hmm. And that the HR department, your head of HR should probably be doing, on a semi-annual basis with senior management team, a review of all of the, up-and-coming management, and that they should also sit with either the comp committee and or the board once a year just to kind of identify who the likely successors are in the key positions. And I think it's a good way to keep apprised of who's on the move and who isn't. And the comp committee tends to generally work with the HR people on a more regular basis, so there's a lot of tie-ins there for what they're normally doing, whether it's around the NEO comp or their incentive programs or 401ks or whatever. There's a lot of interaction between HR and comp, so there should be a more natural line of communication there.
Yeah. And Dick, as I think about this, if in fact that over time the responsibilities of the comp committee will expand to cover these issues and others, I think it might be time for a raise for the comp committee chair. What do you think?
Well, if you had an item number 6 on here, it would be that ISS is going to be developing a new methodology for director compensation. So I'm not sure that would be a great time to be doing that.
You know, timing is important, as you're saying. Timing is important. All right, let's go on to the second part of this conversation about the expanding role of the Comp Committee. And as I mentioned earlier about what I saw as an explosion of interest in ESG and its impact on your incentive plan design, I also think there's been an explosion of interest in related activities, or topics rather, around gender pay, diversity, and inclusion. When you talk about hot topics out there, these are hot topics. And what I think is interesting about these topics is you could take the point of view that the Compensation Committee is responsible for the senior leadership team, and that could be generally anywhere from, say, 5 to 10 individuals for the company. And you could define it like that and say, well, on that basis, the committee doesn't have really any responsibilities here. But if you think about that argument, I think it has a hole in it, and the hole is simply that if you have issues around gender pay, gap, diversity, inclusion, and virtually every company has some kind of issue, some bigger than others. But if you think about it that way, if you don't tackle those issues in the body of the organization, you're never going to be able to feed these people to the top of the organization to attain your pay, diversity, and inclusion goals. And so I think what would make sense for me, from my point of view, is to broaden that charter out to say that the committee has oversight, but we have to draw the line between oversight and just having the committee too involved in addressing these issues. So do you think I'm pushing too hard on this topic? Do you think that I'm expanding the role too much, or does it make some sense to you, Dick?
Well, you know, it's funny because we just had a conversation similar to this at a board meeting last week, and I think that you really have to respect the role of management and not try to get too hands-on. I think it's important for them to do their work and report to the board, but the board really should not be getting involved in those day-to-day decisions. Clearly, the board needs to know if there are issues with respect to gender pay gaps and diversity and inclusion, but they shouldn't be getting into the weeds where they're trying to make the individual decisions. And so it's very tempting to get down there, but that's not what our job is. If you go back to the old mantra that it's noses in but fingers out, you got to be careful you don't cross the line there.
Yeah. Let me throw another topic at you on this topic because, there's so much press on it. And we have this issue around pay gap and pay equity. And I'm going to define these terms because there's confusion around it. Pay gap is simply the median pay of all women divided by the median pay of all men. And when we look at those studies, we see there's about an 80% ratio. There's a gap. And we look at studies come back, broad-based studies, showing about the same ratio. Pay equity is a little bit different. Pay equity says if you take a male and a female that have the same or very similar job, is there a difference in pay? And when we look at that for our clients, what we find is really pay parity for the most part. It's not exactly parity, but it's close enough to say there's really no issues here. And the reason there's such a difference between pay gap and pay equity is on pay gap, what's missing is there's not enough women in the management ranks. And so that's a unique challenge. And I think for companies that have pay gaps, and most companies do, is not only running through the process of understanding what that gap is, but more importantly and more difficultly is how do you solve that problem? And have you gotten to those level of details, Dick, in your conversations yet?
Well, I would say that in one of my companies, thankfully we don't have that. We don't have that problem because we have a lot of women in very senior positions. But I think it's a good practice to do just to sort of patting yourselves on the back all the time. Just make sure that you're doing the exercise. So I would agree with you that can't do it too much, and so I would definitely engage in it.
Yeah. I think this is one of those topics. You're getting to your point is, when does the board go from oversight to intrusion in management? I think this is one of those topics where maybe the committee sends a message to management. We want to see an update on this, let's say, on a semi-annual basis. But this is really management's role to figure this one out, I think.
You know, and I would also say, Peter, to the extent you have a strong HR, leader, they're doing these things on a regular basis. And so one of the things that can help the board is to make sure you've got a very strong person in that position, because they could be bringing you those results without the board having to be pushing so much on it. You know, they should be out in front on this.
Yeah, by the way, I've seen the same. I've seen some very strong HR leaders, and they come fully prepared with a very interesting and detailed analysis to show where they are and plans for addressing any open issues. I think you're right. I mean, this is a topic that belongs with the HR leader and working with the management team to resolve over time. It's a tough issue, though. It's a tough one to solve, but an important issue.
Right.
Well, Scott, I think what I'm going to do is pass this on to you for a discussion of adjusted metrics. So you are on.
Alrighty. So basically, we're just going to go through this section. Just deals with adjusted metrics, and the first slide here is just basically the advantages of using just a non-GAAP metric. Generally, you can see alignment between how companies can communicate their results to investors, and then also just the compensation programs themselves. There's better reflects core operating performance, and then so for when you're comparing year-over-year performance, it leads to more consistency, whereas in GAAP measures, there might be some noise in the numbers year-over-year. Generally, with profit-based metrics, there's common adjustments that people will look into, and this is nowhere near a full list, but just M&A-related expenses, anything related with restructuring, one-time gains or losses would be typical, legal fees or settlements that were just not foreseen in the budgeting process, and also foreign currency translation. So when implementing any adjustments into your measures, there's four things that we've kind of laid out to basically give some thought into how you would kind of determine the adjustments. The first one being materiality, so just how big is the thing that you're trying to carve out from your measures. Consistency, just were these things looked at in the past, and are you going to basically make the same adjustments from year to year? Accountability, and really this is meaning kind of how foreseeable were any of these issues that came up, and were they really outside of management's control at the time, or just not foreseeable? And then also another issue is just the disclosure aspect of it. So when you're using these adjustments, are they disclosed in your 10K or maybe just a supplemental disclosure? And then if the answer to that is no, does that create more disclosure responsibility either through the CDNA or just like in 8K as well? So I personally am very pro adjusted performance metrics for compensation programs, but definitely along with that, if you're going to make any changes from GAAP, you should definitely have a cadence of reviewing these on a regular basis, probably a quarterly basis, and apply consistency from year to year. So, Dick, do you have a perspective on just adjustments, performance metrics in general from the boardroom?
Well, yeah, I would say, Scott, this can be a real dangerous third rail, and I like the way you frame it, because it's got to be material, it's got to be consistency, it's got to be something that's very foreseeable. But I remember once in the 80s working for a company where stock options got underwater, and we actually, the CEO got up in front of everyone and said, the board decided to reprice the options. Very controversial thing to do. But similar along the, the sense that you're making an adjustment to what was a plan. But he also went on to say, I can only do this once. If this happens again, I'm probably not going to be the CEO anymore. So I think that you've really got to be careful what you're identifying, and make sure that if you're doing it, there is the transparency that you're referring to. Because if you're trying to just pull a rabbit out of the hat and something that nobody, thinks is justifiable, I mean, that's really problematic. So this is not an area that I generally feel comfortable with, unless there's something that falls very clearly within the guidelines that you've laid out.
Okay. Yeah. Well, I actually have. It's funny. I have another story where there was a company I worked for. Someone had told me a story about how they were laying something out, and they had some manufacturing plants in China, and they didn't basically make, what their budget because of the Chinese New Year, and they were trying to explain this away, and one of the managers would say, well, is this new? Is the holiday new? How is this not foreseeable? But the person quietly basically kind of withdrew kind of the arguments over it. But I agree with you that, you definitely have to basically plan out kind of, foreseeability in addition to the other pieces.
Right. Well, while you're on it, one of the questions came across the transom here. How do you feel about adjustments for regulatory or legal changes in a highly regulated industry? What's your thought on that?
I mean, my personal view would be that as long as you're applying it from consistently across, from year to year, where sometimes that might help you and sometimes that might hurt you. If it's a new regulation, I think that probably would have some reasonability to it. But I would not, only take that into account, in years where it would help, I guess would be.
Yeah, and I would assume that if something happens in the middle of the year, you also have to take a look at what your peers in the industry are doing, right? You don't want to be the outlier, I would assume.
I would agree with that.
Yeah. We also got a couple of questions rolling back to what Peter was talking about on diversity and inclusion. So if you're about to finish adjusted metrics, I'd like to roll back and ask those questions, but you let me know if you're done here.
I'm done with. Oh, sorry, Pete. Did you have any commentary in regard to the adjusted metrics? I'm done with.
Yes, I did. But I actually wanted to throw a question your way to get your perspective on something that I find I struggle with, and Dick, I'll get your perspective too. It's actually a related topic, and that is, what do you do if you're an acquisitive company? What do you do if you are selling and buying companies? And what I'm getting at specifically is, when is it okay to make adjustments or significant adjustments to results to account for M&A activity? And every company eventually will deal with this, and if you're an acquisitive company, of course, it's much more difficult. And what I found is many comp committees have a general policy, but I've also found that the M&A activity can be so fact-specific that to try to apply specific adjustments to every activity doesn't work very well. So here's what I found, that it's easier to think about how to adjust incentive plans when you're selling a company, and it gets much more difficult to adjust an incentive plan bonus pool when you've acquired a company for a variety of reasons. And Scott, I was just kind of curious about just your general experience. When you worked with clients with M&A activity, do you find that you can apply a general policy, or is it just every activity has to be discussed by itself, and what that impact should be?
In my experience, I think there's kind of two routes that people take. Either it's kind of core, they do like the core earnings route, where everything's excluded for a year, and that's just the way it is, and then after a year it's included. Or, if they try to make adjustments, they will just come up with, I worked in-house for a company that grew through M&A work, and they would just try to come up with a standardized, they would have a number in their head of what standard costs were in the M&A process, and anything that wasn't foreseen would be kind of above that. So they'd have, this would be the legal fees, this would be kind of, these other, kind of criteria, and anything that was completely unforeseen, like say they got like a one-time tax write-off for acquiring the company that wasn't foreseen in terms of purchasing it. Anything outside that was truly one-off would be excluded, but the bulk of the cost would actually be included.
Do you find that committees are able to put general policies in place, or do you find that they're more likely to have a specific discussion about each transaction?
I think that they tend to have, I think they would probably have to have a specific discussion about each transaction, because what I just discussed doesn't really cover what the materiality of how big the transaction was.
Right. Yeah. Dick, I don't know if you have any thoughts on that. I'm not sure how much you've been involved.
I thought that Scott gave a very good answer. I think that, clearly you have to try to figure out what you're going to do with the transactional expenses, but you also ultimately want to figure out what a normalized number is going to be. What is the real run rate once you get all your synergies out? And so almost by definition, you've got to, everything is on a case by case.
Yeah, okay. Yeah, just always ask that question because you never know what wisdom somebody can provide, because I think that's a difficult topic, M&A, and impact on pay. Because you want to make sure that if you have an acquisitive strategy, you want to make sure your team executes on that strategy, but nor do you want to penalize them for making difficult discussions that may impact your cost or your results.
Right. One of the questions that came in, Scott, was a question about, along these same lines, how do you handle currency fluctuations? But I would say that's, if you're in an international business, currency is part of what you do day to day, and there shouldn't be tremendous adjustments there unless you have a different point of view.
I don't. I mean, I know that some companies do and some companies don't in terms of adjustments. I kind of see that. I agree with that. That if you're a global business, you're selling to the world, and that's just part of the cost of doing business.
Right. That's your expertise, right?
Yep.
Dick, did you want to swing back to questions, or did we?
Yeah, if I could, just before we get into the last section here, we go back to one of your previous sections, Peter. What's the panel's opinion on D&I metrics and targets at a functional level within a company? And if you conduct a gender pay gap analysis and you find that there is in fact a gap and there's an issue, how quickly should the company take action? And when do you think that should be rolled out? Okay.
Well, yeah. So it depends how you define action. That's the first comment. But I'll take it literally. When you find out you have an issue, I think immediately you go back to the head of HR and working with the CEO and say, we need to do a study immediately about this to understand in detail what the issue is and come back with a set of recommended actions. So I think that's something you do immediately. The bigger question is, how long does it take to solve these problems? Because some of these problems can take years to solve, because it's not just making simple pay adjustments, it's more about training and hiring and developing. So that's how I would think about this.
Yeah, I think that just figuring out you have a problem is only a fraction of really of the problem itself. Solving for it is the harder part.
Yeah, and because this topic is so, I mean, this is a topic or a challenge that may literally take years to solve. I mean, if you have an issue that you have, let's say, a pay gap because your jobs have changed so much and are so much more reliable on or require a technology-based background, and you need to train thousands of people in technology, that's a multi-year project in my mind, depending on how much change there is. But that's a multi-year project, and probably a project that many companies are currently facing. Not easily solved. And I don't think you can hire your way out of it either. That's the other problem. Skills aren't there.
Okay. Why don't we move to your last section? There was a couple more questions that have rolled in. If we have time at the end, we'll jump to those.
Okay. Terrific. So let's talk about this term that we coined strategic transparency. By the way, I would love to take credit for that, coining that phrase, but I did not do that. But I love the topic. And that's really talking about prioritizing and tailoring messages to your stakeholders year-round. And this is the way I'm thinking about this. And I'm going to go back 5 years again, because that's my time frame. You go back 5 years and you think about the messages around your executive compensation program, and that was primarily handled, I believe, through your CD&A disclosure. And as I mentioned earlier, those CD&A disclosures many times were not very good. They were technically accurate. The CD&A was treated as a compliance document, but it may not have supported your message very well. Now the world has changed because everybody, all stakeholders, are asking many more questions. And the questions they're asking really gets onto the topics, Dick, that we spoke about earlier today. It's not specific executive compensation issues. It's around business strategy, succession, leadership, pay for performance, sustainability, pay equity, and it goes on and on and on. And their stakeholders, whether they be your institutional shareholders, it may be your proxy advisory firms, it may be the customers that buy your product or service, they're all asking these questions about strategic public transparency. And so the question that we're raising here is it time to stop thinking solely about the CDNA being the funnel to the world about your transparency, and maybe a little bit with the interaction with the institutional investors, and to start thinking more broadly about what do you communicate, and how do you communicate, and to whom do you communicate these messages. And so what we've done here on the next page is we've set up a framework that it just helps you think about how do you develop a strategic transparency roadmap. So it's how do you do it, and then why is it important? I think how do you do it, we've got these buckets here, and you certainly can read that. But I think why it's important here, there's a question coming your way, Dick. I think why it's important here is that I think when you start mapping out your transparency, how you want to disclose, I think it helps you crystallize how you want to think about your own issues, and then how you want to communicate that into whom. And I think some companies are doing this right now. They certainly probably don't call it strategic transparency, but they are thinking more and more about communicating. And they're thinking more and more about communicating in professionally written documents, getting back to my comment earlier about that awful CDNA 5 years ago where you have maybe a full page of dense text that you can't understand. I think those days are going away. But I think this is another area that I think going forward, both compensation committees and full boards should be thinking about, because it's in their best interest to think about it. And the way I think about this in particular is if you take your CDNA, you can view that as a compliance document, or you can view that as a compliance and a communications document or a marketing document. So you have to comply, but you can comply in a way that puts your company in the best light or a very positive light. And I think it's the same thing with the strategic transparency roadmap. How do you want to think about that? And I would say that the comments related to compensation, I think we encourage boards to be more and more transparent. I mean, comp committees are more and more transparent. But I don't know if that kind of logic or philosophy is happening at the full board level. Dick, I don't know what you've seen on your end, but you might have a couple of comments here.
You almost took the words out of my mouth, because when I became chair of comp, sat down with the CDA, and I realized that, essentially this is a document that was very well written, but it was the domain of the general counsel's office. Mm-hmm. And it wasn't really viewed from the perspective of who's going to be reading it, and does it, yes, it checks all the boxes from a disclosure point of view, but does it answer the questions that your institutional investors have or that ISS has? And does it really fully describe your compensation philosophy? Because that's the essence of it, right? What's your philosophy, and how are you implementing it? And so what I found from having multiple conversations with institutional investors is the more you can frame the document that answers those questions, anticipates and answers those questions, the easier your conversations are going to go, the smoother things will go. You don't have voting issues. And I think it just helps everything. So I would take it, I would say to all the people on the compensation committee, grab the wheel, okay? Don't just let your counsel's office write this. You might even want to get your IR people involved. But it is a document that's a combination of disclosure and marketing. I think you said it very well, Pete. You've got to think of it from the point of view of people really do spend time reading it. And this is where you want to put your ESG matters in. This is where you want to be very clear about your compensation philosophy. And to the extent possible, you want to be clear about where the NEOs have hit their metrics and where they haven't, and why. And you can look at a lot of these documents and they're all over the place. But the last thing you need is something that's written in very thick legalese.
And Dick, I'm going to give you an example. I'm going to throw out an example of what I've seen. This is a little bit unique example, but I've seen versions of it across the board. I remember reading a proxy. It was an old-style proxy. And did it comply? Yes, check the box, it complied. But I remember one page. If you can think about this, the entire page was text, 9-point font, spaced on top of each other. A good portion of it was describing the annual incentive plan results. No bullets, no charts, text. it literally took me 5 minutes to understand what that was saying. It was actually an entire paragraph. That was one sentence. Can you imagine? And so
yeah,
we were asked to give a hand on that, and we transformed that entire text of 9-point font into 2 well-designed charts, a whole bunch of bullet points, and maybe we got that down to a paragraph to support it. And instead of taking 5 minutes to digest that information, you probably got it down to 2. So not only is it easier to read, when you think about your proxy advisors who are reading this same information, don't you want that kind of style in your executive summary so that they can fully understand your plan design so they don't make mistakes in their recommendations? I've seen it on my end. I'm not sure if you've seen something similar on your end.
Yeah, and in fact, I would say to everyone, go ask your comp consultant who they think are the best at putting out proxies in terms of not just the jargon, but all of the graphics that go along with making reading it a lot easier. And I've heard people say, Coke does a really good job. I think Pepsi might be in there also, but there's a handful of companies that are just always at the forefront of making it easy to understand and have great disclosure and great graphics. And I think you want to maybe convince your general counsel that you've got to give up the ways of the past and start to get a little bit more with it, because people are spending a lot of time reading that now. And I hate to say this, but when you talk to ISS, you've got to remember the people that are reviewing the CDNAs are generally the younger people in the organization, and they might not have be as nuanced in what they're looking for. So a lot of times they're just they got algorithms that are just picking up buzzwords. You got to make sure you've got the right descriptions in there. And so I've tried to press ISS on what those words are so I can make sure I put them in, but they won't tell you.
And I'll take your, first of all, we're in full agreement, obviously, on this topic. And if you take that broader conversation about strategic roadmap and communications, apply the same concepts when you're talking to your investor base, who is now asking a lot about ESG. So it's the same idea. Think about ESG, what's important to you, develop a communications roadmap. In plain English, lots of charts and graphs. That's a more powerful presentation. It only benefits you.
Right. Well, Pete, while you're on the topic, someone just asked the question, how would you recommend dividing up the communication to investors and proxy advisors between the board and committee chairs and the management team? How do you see that generally getting bifurcated?
Well, I can tell you what I see. I'm going to refer specifically to the CDNA because that's really the cornerstone for most companies, Dick. And I'll tell you what I see as, I'm not going to use the word best practice because I really don't like that term. I think that's something that we all put labels on. But I'm going to tell you about an effective practice that I've seen. And I'm going to tell you why it's effective before I tell you what it is. You made a comment about the legal folks owning that document. And of course, that document needs to be technically correct. And the challenge isn't so much just the legal folks, it's that you might have literally 10 to 15 people reading that document and providing edits, both internal and external. And it's not possible to have a coherent writing style when so many people edit it. So what I've seen as an effective practice is that the head of HR owns that document, and they use the resources internally to update it, and that the committee gives the responsibility to the committee chair for signing off on the final document. So that although the committee members will read the document, the committee chair will decide on final edits. And I think when you go through that process, you get the input you need, but you have less people touching it and making it a document that is hard to read instead of easy to read. And of course, if you have an outside advisor, you do want to send it to the advisor too, just to make sure that you have the compliance right. But I find that kind of process where you limit the number of people making decision on edits is you'll get a better result than having it open-ended.
We actually have a slightly different model. I mean, it's really more of a collaborative effort between me as chair of comp and our general counsel, with input from our comp advisors and our IR people. So there's, but more of the decisions are between myself and general counsel, but we're getting collective feedback from everyone, particularly since many of them are getting questions from institutional shareholders. So we're trying to figure out how we can then feed that into the document and make sure that we're trying to be responsive.
Yeah.
While we're on that topic, one of the questions came in saying, you know, a lot of the CDNAs are talking about shareholder engagement efforts, even if they have strong say-on-pay results. So the question is, do you see that as a growing trend? I would say yes, but then they go on to say, how important is it to demonstrate board responsiveness and open dialogue with respect to investors as it relates to compensation matters? I'll just say quickly, when we had a situation a couple of years ago where we fired our CEO and CFO and had a challenge with our say-on-pay because we had to honor their severance agreements in their contracts. So we were very engaged with institutional investors explaining that, and once they understood that, it was like, okay, I get it. Either you let those guys in if you feel if you're underperforming, that's not good for the company. If you bring in more professional management, that's going to be good in the end, and stock price should go up. So everybody got that, but it was hard to put it into the document. So it's really important in situations like that to engage. And I think what we learned as a result is there are a handful of institutional investors that want to have an annual dialogue. Just make sure that you make yourselves available. Sometimes they'll want to, sometimes they won't. But being available and being proactive, offering, goes a long way.
Yeah, Dick, I have exactly the same experience, by the way, and I'll start at the end and wind back to your earlier comments that you won't be able to get the attention of your institutional investors every year. They're too busy, and if they think you're doing a great job, they just won't get on the phone with you. But that's okay because you can't expect to touch base with everybody. But it is important to touch base, as you suggested, with those that are interested. And with regard to having that text in the CDNA about engagement, I do believe, like you, that it absolutely is a trend. And I think it's important for two what may be obvious reasons. We'll start with the proxy advisory firms. First comment, they should not tell you how to design your plan. We know that. But it is helpful if you can be as transparent as possible, and really in all of your design decisions, but particularly about shareholder engagement. They want to know if you're engaging, and they will listen. I mean, you will get points in a positive way from your proxy advisory firms if you communicate that you're engaging. You don't have to go into specific details, but you want to talk about that. And I think your other point about institutional investors, yes, institutional investors raise some very good questions about your plan design. And sometimes you're so close to the plan design, you don't know if it's worth mentioning a particular point. But if your institutional investors are asking you about something, sure, you want to make sure that you communicate that. And the fact that you've asked, you've listened, and you've responded. And you can make a little bit of a chart about that. Particularly, by the way, in cases where you have a failed say-on-pay, you want to develop that chart. This is what we heard. This is what we did, and this is why we did it. That's a very powerful communication. So I'm leaning more and more when I give my view, when I'm asked about communicating, be as transparent as you can, particularly about sensitive issues where you may be receiving criticism. I think it matters.
Getting out in front helps a lot. Here's another question that seems to be coming in fairly frequently. How can you use TSR as a metric in a way that will satisfy investors who demand that management get paid in line with the performance of the shares owned by the investors and can provide incentives for management to achieve tangible goals that benefit the company's financial or operational performance? So, it's the old TSR question.
Yeah,
go ahead, Scott.
Well, one way of incorporating that, if you're not sold on basically having TSR as just the sole metric, you can incorporate a modifier in that. So you could have a financial metric which pays out on a certain thing and just have, say, like a TSR modifier, relative TSR modifier, that would increase or decrease the earned payout by, say, 25%. And that way you could incorporate both into that, your strategic goals and also just TSR.
Yes, Scott, I fully agree. And by the way, Dick, I want to say that is a fabulous question. And I'm glad someone raised it because I kind of get on a little spiel here. Aside from Scott's point about using a modifier, which I think is a very effective tool to address that issue, one other way to think about this is when you're researching the correlation between financial metrics and total shareholder return, you'll come to some conclusions about what metrics are more correlated to TSR. And I think it's very possible to make the argument that you've done that research that, let's say, as an example, return on invested capital is highly correlated to TSR. And because of that, we believe that's the appropriate metric in the long-term incentive plan because it provides better line of sight. And the other comment, if you're trying to get away from TSR, we'll make a comment. TSR as a measure of value creation over a long period of time is extremely important. But when used as an incentive plan metric, it's challenging because TSR can lead or lag financial performance for significant periods of time beyond 3 years. So if you are thinking about getting away from TSR, there's some strong and compelling arguments that you can articulate clearly in your CDNA to explain that. And by the way, there are many, many companies that still do not use TSR in their long-term plans. You would not be alone if you change that metric.
We don't use it either, and I'll just say for those that do, if you identified a peer group, make sure that you make allowances for M&A within that, because if someone has an offer outstanding and their stock is, is buoyed by that, it will skew the results. And here's an example where your management team is getting, will be viewed as an underperformer, and they had nothing to do with that. They could be hitting the ball out of the park, but
yeah.
The peer group gets wacky. We are coming up towards the end here, and I know that we have a quick slide that we're not going to have time to go through, but there are key takeaways towards the end that everyone could review that I think do a very good job of just summing up everything that we talked about here. But since we only have about 2 minutes left here, and I know that we need to defer to Sienna for a few wrap-up comments here, unless Scott or Pete, is anything you want to say real quickly, I will defer to you and her.
Yeah. The only comment I have is since it's coming out soon about EVA, I want to reiterate what Scott said earlier in the presentation. It's generally not a great time to use your resources to go down a deep analysis of EVA. Just let's hear what ISS has to say about it next year, and then consider what actions you want to take. I just don't think it's a good use of resources today to get down that analysis. That's my overriding comment there.
My only add was basically to just the conversation we had earlier about shareholder outreach. My thought is, if times are good, reach out to your shareholders, because it's much easier to reach out to them during good times than bad. Just establish the relationship, in addition to everything that Dick and Pete have said in regard to that. But it's just an ad that
Well, and I would say when times are good, talk to your institutional shareholders, and when times are bad, talk to them more. That's when they want to hear from you.
I agree.
Yeah, spot on.